Now for our feature story of the day. BlackRock signals a paradigm shift with an 84.9% allocation recommendation for the King crypto. And I'm going to be breaking down the math, which signifies we can hit a $47 million Bitcoin price if the major asset managers follow the recommendation of BlackRock. So check it out, as you can see here in the headline. But I'm actually going to start here. There's a tweet I made a little while back with BlackRock allocating their optimal portfolio allocation into Bitcoin of 84.9%, according to their very own study released in 2022. That will send the Bitcoin price action to $47 million per coin. And quoting Samson Mao, the math checks out. Bitcoin is going to 47 million per bitty. Now let's break down the math from Macronaut BTC. Shout out to the Macronaut. BlackRock, and this was at that time, had less than what they have now. FYI, at that time, they had 9.4 trillion in assets under management. 9.4. 0.849 for the right Bitcoin position percentage equals 7.98 trillion. And BlackRock will need to allocate to Bitcoin to follow their paper. 7.98. 118B of a multiplier equals $941 trillion market cap. So Bitcoin will be about $47 million per coin. So there you go. But let's dive deeper into this article, family, now that I shared some of that with you. In a significant departure from traditional stance and cautiousness towards cryptos, BlackRock, the world's largest asset manager with roughly 10 trillion in assets under management, they did a research paper titled Asset Allocation with Crypto, Application of Preferences for Positive Skewness, suggesting Bitcoin should make up a substantial 84.9% of an investment portfolio consisting of 60% equities and 40% bonds. Let's go. The BlackRock researchers conducted an in-depth analysis of Bitcoin performance and returns, and during this period, they found that Bitcoin exhibited considerable volatility with an annual rate of 132%. Now, here's the actual tweet I wanted to read to you. It says, last summer, BlackRock put out a paper stating starting with a 60-40 equity bond portfolio, the optimal Bitcoin allocation is a large 84.9%. But let's read it directly from the horse's mouth coming from BlackRock. I'm going to read this to you. We perform the following asset allocation exercise. Suppose we start with a 60-40 equity bond portfolio. Assuming the equity and the bond returns are log normal, fitted to the moments reported in the data of Exhibit 1, we compute the power utility risk aversion coefficient to yield a 60-40 allocation. In this case, a risk aversion of Y equals 1.5 corresponds to the 60-40. Then we hold the risk aversion fixed and the estimate with the optimal weight of Bitcoin. And assuming that the equity and bond weights are held at the same pro rate 60-40 allocation, that is, the equity and the bond weights are set to be whatever that math I can't read because I'm not a math whiz. We use the mixture of normals distribution for Bitcoin returns that captures large positive skewness. Now for the highlighted section, which is highlighted in the yellow. Exhibit 4 presents the results, starting with a 60-40 equity bond portfolio, which is produced with a risk aversion of Y equals 1.5. The optimal Bitcoin allocation is a large 84.9%. The remainder of the portfolio, 15.1%, is split 60-40 between equities and bonds. Now for the green highlighted section. Pay close attention to this part. Although Bitcoin has an extremely large volatility of 1.322, the pronounced positive skewness leads to large allocations and dominates in the utility function. And now I'm continuing. The certainty equivalent compensation required to not invest into Bitcoin is close to 200%. Whoa, if Exhibit 4, starting with a 2080 stock bond portfolio leads to 12.5% Bitcoin allocation, and a risk-tolerant investor with an 80-20 stock bond portfolio desires a levered position in Bitcoin of 106%. So what would happen with a levered position? That's how you can get to 200%. Mind-boggling. The possibilities are endless, family, but continuing on with the story. What sets Bitcoin apart is its positive skewness, as referenced in their report, when expressed in terms of continuously compounded returns. And in contrast to this, equity returns showed a percentage of negative 0.43%, while bond returns were at 0.01%. Jesus. Bitcoin's third central moment of returns was an astonishing 144% annually, demonstrating a stark contrast to traditional equities and bonds. This unique characteristic of Bitcoin's return make it an appealing asset for investors seeking substantial gains. Stack the biddies, fam. The research also highlighted Bitcoin's consistent propensity for significant gains. While returns often follow standard patterns, there are exceptional periods labeled as bliss regime, during which Bitcoin prices soar over 100 times annually. This level of return potential is what attracts the investors aiming for substantial profits. And even when Bitcoin is expected to depreciate in the standard scenario, the research noted investors focus on maximizing profits tend to allocate 3% into Bitcoin. This allocation remains consistent even when there's only a 1% chance of a highly profitable scenario materializing. Now, BlackRock's recommendation to allocate a substantial almost 85% of Bitcoin in a 60-40 equity bond portfolio marks a significant departure from the conservative approach traditionally taken by many financial institutions towards crypto. And it underscores the growing acceptance and recognition of Bitcoin as a legitimate asset class that can offer substantial returns. The move by BlackRock follows the US SEC's clearance of the ETFs, which officially went live for the Bitcoin spot back in January of this year. But I want to know your thoughts surrounding some of this math. Do you believe Bitcoin will likely hit 47 if it theoretically had that level of allocation as shared here by Samson Mowen via BlackRock's own report? Now let's just keep it 100. Most likely, if we were to see this level of asset allocation, it could take a decade, it could take 2-3 decades, I don't know, but that's a lot. But hypothetically speaking, what if it was just 5%? We're talking about a multiple $1 million Bitcoin price action. I feel 5% is very conservative. Here's how I feel the plot will go. I think asset managers will start very conservatively, as they kind of already are, maybe 1%, 2%, 3% allocation. They're going to see the returns fantastic, especially post-halving when we're about to go parabolic, hit a new cycle peak, potentially at a 0 to that price action you see on your screen. Then the following year, they're going to be like, okay, 2% was great. We're seeing all these returns from our 2% allocation. All of our other investments not doing so well. So let's go from 2% to 4%, 4%, from 8%, 8%, 16%, 16%, 32%, 32%, 64%. You know what I mean? You're starting to feel my vibe. And before you know it, they may have an insane allocation into the king. But let me know your thoughts, family, and welcome to the Q&A segment of the live show. JV streaming live and in the flesh. I'm going to read as many of your comments out loud as I can. Let's go. I feel sorry for all those that sell at 100K because I will be buying along with all the institutions. Amen, Molly. You're smart. Number one, Bitcoin ASAP. Amen. Crypto made. Bitcoin will go below 50 before breaking all-time high. For real this time. The break was a liquidity grab, not true value. 47 cents a sat at 47 million. Send it. And $1 a sat would take us to 100 million Bitcoin price. Jack Mullers is a part of the crypto hoodie gang. Huddle gang, hoodie gang. 50 million, 20 years out minimum. Nobody on earth reads the crypto news like JV. He's just the best. Thank you, Molly. I'm humbled.